on board Rishi Kohli. He's Chief Investment Officer at Jio BlackRock Asset Management, joining us this morning to kind of contextualize everything that's happening in markets. But Rishi, just with regard to, let me start off with the big headline of the day, right? And the kind of move that we're seeing in IT this morning. What's your sense? Where do you stand where IT is concerned? Do you believe that terminal values will get impacted, won't get impacted? What's the sense like? Companies coming out and defending their business models, clearly. Your sense?
Yeah, so I think near term, definitely there is impact, and I think it will take 1 or 2 years, for it to sort of play out. So whatever weakness we'd seen recently, obviously it was overdone from both valuation as well as price perspective. So you're seeing this bounce start happening since the last week. I wouldn't be surprised if it, gives a further bounce, another 5-10%. But overall, it won't be like a secular trend is the broad feeling that I have based on whatever data we are seeing. And the AI trade, etc., obviously, that has impacted. And we do know that some of these companies are getting projects related to AI. But as we all know, that is a much longer term thing. So as we see more of that action, I think then only we'll be able to bake in those into the numbers.
And revenue compression, you expect that to also play out either near term or eventually?
So as of now, it is there clearly. You can see it in all the company numbers or stagnant. And I think that can happen until the new project impacts start coming in.
Where else are you seeing this kind of value and price both matching them on the table right now? Or do you think largely the market is discovered and overpriced?
So I think it is very, very dispersed. So there will be certain sectors, and then within sectors also there'll be different pockets of stocks. So it's become a very, very, that way a stock pickers market, while it has been difficult last 2 years. But I think right now, based on all the statistics that we see, based on dispersion and volatility, it looks like, you really have to be very, very selective. In terms of sectors, pharma is looking good overall. And then, of course, selectively
so still
reality.
Undervalued, even after the recent run-up?
Yes. I mean, undervalued meaning the combination of valuation, earnings, all of that is still pretty healthy there. You have a lot of room for it to go. And then smaller sectors like realty, for example, are also looking good. Again, they've had a sharp rally recently. But again, selectively, I think it's still looking good. Larger sectors, I think financials on the margin is looking slightly better than earlier. Especially the private banking side. I remember, we've spoken last few times. It was always PSU banks, not private. We discussed a lot about it. Now it looks more like private for the near term.
You have moved your preference from PSU to private now?
Overall, they both look good. But yes, in terms of relative valuation, the stability that has come in, the NIMs, etc., all that, I think private is, again, it has slightly outperformed recently, but I think there's more to go on that.
How do you look at volatility, especially the short-term volatility now? I mean, since Feb end and now, the way the entire US-Iran, crisis is playing out, how do you look at that volatility? How should investors and mutual fund investors look at it?
Yeah, perfect. So for now, largely the larger volatility has settled down. But obviously, we know President Trump comes and tweets and markets react even over the last few days. So I think that is still there to stay. And that creates those jerks around Fridays and Mondays. But overall, of course, with the crude spike and with the larger news that was there every day, that has definitely settled down. And crude, luckily for India, has settled down to much lower levels. I think there'll still be some volatility. It'll still be in a larger range for some time before fully settling down. But fair enough assumption to say that it'll still be on the lower side. If it's still in the $70 to $80 range, even if it goes up to 80, it's still okay for India. So from that angle, for Indian markets, it's, I think, healthy in the medium to long term. And overall volatility has subsided, of course, since then. And I think it'll remain like this going forward a little bit. Also, earnings have come out better, than what we were expecting, the worst we were fearing after the war. So depends on this quarter, next quarter, if that trend continues or even is stable, I think it'll be fine for Indian markets.
Rishi, the more important thing in these volatile times, while everyone has learned it the hard way that asset diversification is what really sort of works, and you saw that play out all through 2025. But I think now is more about how do you hedge against risks and over ownership in certain asset classes.
Correct.
What strategies do you propose for MF investors now?
Yeah, so for MF investors, in fact, I mean, we've just in the middle of our NFO for the SIF strategy, we have launched our Prism hybrid long short SIF. So I think these strategies are great for these kind of market environments, whatever we've seen in the last 2 years. And there's a very high probability next 1.5 years will be like that, where markets will be patchy. You know, some months will move up, some months will move down, be volatile, not very easy from a long only perspective. And therefore, I think the value of these kind of strategies comes in because especially the hybrid SIF category, I think everyone in the category is targeting absolute returns, fixed income plus, arbitrage plus, however you want to frame it, those kind of returns with very, very low risk, like 1, 2, 3%, which really is sort of the missing middle that India has had in terms of products, right, between equity and fixed income. Also the taxation, because greater than 1 year, you get actually long-term capital gains equity taxation in these hybrid SIFs. So these become great strategies because if we say that, long-term equity market returns in India have anyway been like 12, 13%. And these kind of strategies are like arbitrage plus 3%, so bordering on 10, 11% also maybe. So that becomes like just under equity returns with that lower risk and with the equity taxation benefit. It becomes like a great product instead of doing a lot of asset allocation. This can potentially be a core allocation also for a lot of investors. Of course, not for new time investors. They'll need to have small allocations to begin with and then scale it up. But for a lot of equity heavy, fixed income heavy, and other portfolios, it becomes like a very clean, easy fit.
Interestingly, this SIF has redemption of twice a week. Initial SIFs that we have seen, it was once a month or once in 2 weeks, which is there. The redemptions are getting narrower, right? It's almost going towards a daily redemption.
So you're referring to the AIFs. So the AIFs had the monthly redemptions. Here, when SEBI has got out the regulations, they have said twice a week for hybrid. But yes, so the liquidity matters. So I think the relevant point there is liquidity and risk around that. Because there are a lot of interesting strategies you can do, but you may not be able to get daily liquidity. So I think liquidity and risk becomes more important for this category especially because returns come out. If there are sensible strategies, the returns will come. But at what risk and what liquidity aspects, I think that becomes very important. So what we have done, for example, our team has done is that they have really mapped that liquidity and risk very well. So what we have done as a team is that wherever tail risk can be eliminated. So if big gap downs of 10, 20% happen, the excuse should not be that, something new happened in the world and therefore now my 2% drawdown has become 5%. So those kind of tail risks have been eliminated, which I think is a very powerful thing in the long run because as that proves out, it becomes a very, very solid category to get into. The other is the liquidity, as you were mentioning, and that is sort of related to the risk because, for example, if you take credit risk, right, you again know a problem will happen once in 5 years, but when it happens, neither the liquidity nor the risk is in my control. So for a product like this, I wouldn't be comfortable taking that as well. So there are these various aspects where, we've either not taken risks where tail risk can come in or eliminated tail risk completely. For example, a covered call strategy, which is there in all the hybrid funds, right? So we are calling it collars if you look at our presentation. And the reason is we are hedging it out fully. So globally, if you hedge out fully the covered calls by buying the puts, then you'll call it collars. And that's what we are doing because we are saying that we want the max risk in that strategy to be only 2%, right? So as tight as that. And similarly for many other strategies. And we have some unique ones like merger arbitrage, allocations to InvITs, for example. Everyone has these strategies, but we plan to have much more active dynamic allocations to these. And there also the dynamic allocations are related to the underlying liquidity and accordingly the exposures go up and down.
But Rishi, this is of course for the more seasoned investor, go for SIFs. But for the SIP investor, what should be the right asset allocation in this market right now?
So I think keep it simple, allocating across index funds a little bit across mid, small, large, all of them because there's no very clear view on what will do better. But mid cap overall has been having better earnings growth, whether it's last year, expected next year, a little more sort of moving together. Small caps is obviously very, very large universe and very scattered in terms of stock selection. So I would, sort of allocate equally, but slightly more to mid cap. So let's say 30 large, 40 mid, 30 small, something like that, I think is good from an equity allocation perspective. Sectoral rotation is something people can do, but again, not easy for individuals to do. But if there are advisors or simple models someone is using, then you can probably use sectoral index funds or ETFs as well.
Very clear. But give us across asset classes, what's looking best from a risk-reward standpoint? Is debt looking better? We've had no strong inflows in debt for a while now, right? I mean, it's one of those ignored kind of asset classes, but the returns don't seem to be enthusing the street either. So how should one look at it across asset classes, gold, silver, debt, and the like?
So interestingly, we are all talking about equity markets being tough last 2 years, but if you look at fixed income, as you said, that also has been very patchy last 2 years and very difficult. So that's the reason why, the interest has not been there. And of course, the larger taxation issue still remains. And, every budget we think that maybe, something will come in for the fixed income taxation, but obviously it has not till now. So that is the dampener. And actually the SIFs I was talking about, the excitement is because of that as well, right? But yeah, going back to the asset allocation, I think I mentioned I started with equities and the market cap allocations.
Yes.
Because from here till December, I would be a little bullish on equities.
Okay.
We've had a tough 6 months overall, but a lot of factors recently on the margin changing. We talked about earnings, geopolitics, crude, but also if you look at FI flows, which everyone has been worried about, talking about it. And this is something I mentioned many times in many forums earlier, that I never worry too much about the FI flows, because in the last 10 years, before that it used to be a lead indicator, but in the last 10 years, they have become like momentum players, right? So you see 3 months, 6 month positive, and flows will start becoming positive. And that's what you've started actually seeing in the last few weeks. But because it is the most under-owned by FPIs, in the entire history almost. So I think that has a tailwind. If that keeps continuing, that can be a large flow that comes in. Domestic flows remain strong. Earnings, as we discussed, has been slightly better. So if on the margin also it is stable to better, I think, the next 6 months can be pretty good. And, rallying 8-10% will not be a big deal if some of these factors remain steady or improve further. So from that perspective, from an annualized return perspective, it becomes very interesting. Silver and gold, of course, given the rally in the last 2 years, is always a favorite topic. In the long run, I would be quite bullish. But in the near term, I think it is going to be very volatile and very difficult to sort of time and take advantage. So the only thing is, from a long-term perspective, if that positive or bullish view is there, then you can obviously take advantage of the volatility to, buy on dips or whenever the volatility comes in.
Two quick follow-ups. You spoke about FI buying. Do you believe that there is a higher, obviously no one knows when it's going to happen, but higher probability at this point that FIs will come back given the context, AI and all of the other plays? Second is earnings. Do you believe that earnings will surprise on the upside, given that some part of the margin contraction, if I can call it, of Q1 has been passed through in terms of pricing? So therefore, could earnings actually surprise on the upside? Those could be key triggers.
Right. Yeah, so I believe, this quarter may be a little mixed because the impact of the war and other things, on some sectors will come in this time. But yeah, going forward, the next 1 or 2 quarters, I think can be better than we're expecting.
And FIs?
And FI flows, yes, I was just referring to that, right? So that has just changed on the margin last few weeks. And given the positive view that I have, like I said, trailing 3 months, 6 months, remaining positive, I think the flows keep building up. And the anti-AI theme, can easily play out to our favor, because that has seen sort of a halt, globally. Of course, there'll be pockets, I think, which will still do well. But as an overall theme, just investing into all the AI stuff. Actually, if you think about it, during the war, that made sense, because you want to go into, sort of defensive stuff where you have full clarity, no surprises, and that was AI. Correct. So apart from the earnings growth in some of those companies coming out very strong, that was sort of a defensive trade. With the geopolitical things going away, I think there'll be less pressure of that, and therefore India will become a natural thing people look to.
You spoke about AI. I want to get your thoughts on how you're using AI for your fund management, because you have Aladdin, which is there, and how are you leveraging it from getting investors into it? And the reason I'm asking is, now we have the largest asset manager also coming off the IPO, and they're also looking at AI as a whole. So what is your experience and how are you leveraging it?
Yeah, we leverage it on multiple levels. So as you said, Aladdin, of course, we have, which is more an end-to-end integrated platform. It has elements of AI, ML into the data that we have, the models that we build, etc. But more importantly, it's an end-to-end integrated platform across risk, compliance, trading, portfolio management, operations, and therefore makes things very, very smooth and very fast. But otherwise, in different funds, like in the FlexiCap fund, we've discussed minorly before, we use AI/ML models. So there is a certain bucket of signals that we have, which is based on AI/ML. So let's say we have 400 signals on every stock in India, okay? Because different data points which have any value of giving indications for a stock is what we call a signal. So we typically in India have 400 signals for every stock. And obviously we can't use all 400 at all the time. So there are the top 30, 40 which have weightages all points in time. What do you do about the rest? So on the rest, an AI/ML model runs and that becomes like another signal, right? So that is one use of it. The other is alternative data. We use a lot of alternative data, online sales, job postings, chat message boards, interestingly. Now, a lot of this seems like noise, but with the right models, you can actually make some sense out of it. And that becomes further signals that we can use. So there's a lot of AI/ML that goes into all the alternative data analysis as well. And there, of course, we are supported by globally. BlackRock has this BlackRock AI Labs. So I'm not the expert in this area, but we do get a lot of support from BlackRock AI Labs, which has some of the best Stanford profs, which are some of the best names in the AI world globally, actually advising us there.
How much of additional return that you are able to generate because of this?
So
Or for
we
the
don't look
investor?
at it that way. It is more like signal efficacy. And if there are 30 buckets and there are a few more on alternative data or this AI/ML piece, then each of them will have very different sort of risk-reward ratios. And you want non-correlated signals to be there so that it adds value. So from there, of course, around 15% of the FlexiCap model, for example, are these kind of things, which over time will have a large impact. But right now, it's been a very short period. So obviously, you can't
Just
demarcate.
calculating the cost
Yeah.
efficiency.
Yes.
Okay, well, Rishi, great to have you in the show. Thank
Same
you so
here,
much
thank
for
you.
your time. Good speaking with you.